You mentioned that higher oil prices could be the trigger for a recession. Can you expand on that? How would that be the trigger?
Sure. So I don't think anything close to current prices would be a trigger. If we're going to get it from oil, what you need is to get the price to a high enough level that it actually forces consumers to consume less, whether it's buying fewer products and reducing diesel demand from the sort of freight and sort of supply chain aspect of oil demand, or whether it's through directly reducing gasoline consumption, either through sort of discretionary trip reduction or through less commuting to work.
Is the rise in the oil price going to be unaffordable for many people and put even more pain on consumers? That is the theme of our discussion with a guest who has correctly called for the oil price to spike higher this year and potentially even go even higher from here. He is Josh Young, CIO of Bison Interests. Earlier in the year, he was on the show calling for ultra-high oil prices. We'll revisit that call and his thesis as to why oil may be going higher. Thank you very much for coming back, Josh. Appreciate it.
Yeah, David, thanks for having me back on.
We will revisit your call from April. Back then, the price was, when we spoke, the price was around $79 a barrel. It then went down to about $68, $65 a barrel before rebounding back up to $90, 89 we're speaking today. Big moves in the oil market this summer. So we'll talk about what happened and what you think is next. But first, let's talk about some recent news coming out of Russia. Russia's diesel ban has spooked markets. I'll just read you a paragraph from this BNN Bloomberg article. It says Russia temporarily limits diesel and gasoline exports. Russia temporarily banned exports of diesel in a bid to stabilize domestic supplies, driving European prices higher in an already tight global fuel market. So far this year, Russia was the world's single biggest seaborne exporter of diesel-type fuel, narrowly ahead of the U.S., according to Vortexa data compiled by Bloomberg. The country shipped more than 1 million barrels a day during January to mid-September, with Turkey, Brazil, and Saudi Arabia being among the main destinations. So let's walk through why they made this decision and the impacts in the markets.
Okay, great. Yeah, sure. So, Russia, along with OPEC Plus, has been trying to support the oil market. And in a period of slightly weaker demand than consensus, OPEC Plus has been pulling supplies out of the market, both oil and in this case, oil-related products like diesel. And so I think Russia pulled their diesel exports partly to hurt Europe. I think they're still upset that Europe is cohesively or mostly cohesively supporting Ukraine. And so I think this is sort of a specific target. I think it's less sort of general oil market related, even though the broad activity of withholding supplies is supportive of the oil market. But again, this particular aspect, which is withholding diesel exports, I think it's more related to the conflict and less related to sort of the general oil market. And I don't think it's going to have a material effect, because if you see the overall Russian exports, they actually have sort of made up for lower diesel exports with higher crude oil exports. And so it's really just not having much. It's a sort of fun, sensational headline, but it doesn't seem to be really making a big difference in the oil market. And I think it's one of those tough things where you look at these sort of global markets and most of the things that people talk about almost don't matter at all. And then there's a few things people in many cases don't talk enough about that matter a lot. So in this case, I just put it in it's an interesting headline, but I don't think it really matters to the global oil market going forward.
Okay, I'm just going to read a quote from this article. It says, despite this being only a temporary ban, the impact is significant as Russia remains a key diesel exporter to global markets, said Alan Gelder, Vice President of Refining and Oil Markets at consultancy Wood Mackenzie. He said the global refining system will struggle to replace those lost Russian volumes at a time when global diesel inventories are already at low levels. Is he right that we're not going to be able to absorb this loss in supply anytime soon?
Um, not really, and it's sort of odd to argue with someone who's not in front of me. But no, I think we'll be okay. And I think when you look at sort of the seasonal aspects of supply and demand, we're leaving the summer season and we're getting into sort of a seasonal low point for diesel and gasoline demand. And so I think we'll be okay. I think the question is, will Russia sustain their export ban going into the winter, which more of an effect? And then will the sort of aggregate Russian oil and product supplies to market fall, or will they stay sort of in line with their low levels, in line with their commitments to OPEC Plus and their voluntary additional cuts?
But outside of Europe, here in the U.S., where a lot of our viewers are based, does this Russia ban have any impact whatsoever? Does our diesel come from Russia?
Not really. And again, it really depends on what other products are coming. So one of the big things that spiked diesel prices and refined products prices generally in the US last year is that US refiners were importing partially refined oil from Russia and then finishing it, particularly East Coast and sort of other non-Gulf Coast US refiners. And so as those supplies of partially finished refined products were withheld from the market, that sort of caused some logistical issues for U.S. refiners, and it ended up spiking refining margins and prices at the pump for gasoline and also for diesel. Those sorts of disruptions have sort of been mitigated. And then there is really this question of what is Russia supplying to the market instead, to the extent that they're maintaining their level of supplies with this news and just sort of adjusting from supplying, let's say, finished diesel to supplying, unfinished diesel, which might sort of meet this technical specification, but not really have the same sort of economic impact that folks are talking about. So again, it really depends. We'll see what they actually do, but so far, when you look at the data, they followed through on their commitment, similar to Saudi, and that's part of why we're seeing higher oil prices right now, despite, again, sort of a little bit weaker demand globally due to, we're at all-time high demand levels, but we're not quite as high as I would have thought or others would have thought. Again, there's global sort of economic weakness, and the flip side is Saudi and Russia are withholding supplies. But again, this specific news around diesel, I'm just not sure. I'm just not sure that it matters that much.
Okay, so let's go back to the overall crude oil market then. Many people have commented that it's a purely supply issue as to why the price went up by an order of close to 40% over the last 3 months. What's your take on what happened?
Yeah, so we actually just put out a white paper showing, we saw a few months ago, I think around when you and I spoke last, we saw that there was actually we were getting to a low point in the freight market, and freight is a big consumer of diesel. To essentially, you're talking about trucks and various other sort of logistical boats, trains, big users of diesel that get products from China or from various other markets to the U.S. to stores for consumers to purchase, or I guess Amazon in some cases, and then deliver directly to homes. So the trend up till that point had been pretty negative as consumption post-COVID. We had seen this goods boom, and then goods were falling off. Goods consumption was falling off as services was booming due to this sort of reopening trade. And so after that, what we've seen now and what we forecast starting in May of last year was that freight demand would have sort of bottomed or be bottoming, and that we would see some inventory essentially restocking. And so we're starting to see that now, and we've seen that over the last few months. And so with that inventory restocking, we've seen higher demand for diesel than many folks thought. And again, this might seem contradictory with a prior comment I made, which is that we're at global all-time highs for demand, but it's disappointing. It is disappointing, but it's still, for for freight a higher level than a number of folks thought. And when you look at the sort of headlines about China imploding supposedly, which didn't really happen, and we talked about that too, how slow growth is not implosion, and terrible, scary things can be terrible and scary, but also not mean the apocalypse. It could just be that their real estate sector is not doing great, and a few other sectors are struggling, but they're still growing year over year, which means more oil consumption. So again, back to freight and back to diesel demand, it's better than the consensus, but it's still pretty weak. And so that better than consensus is a driver for price beyond just sort of lower supplies than expected. So there's multiple aspects to this market. It's not just supply supported, where it's not just that OPEC Plus is supplying less. There's also other attributes here that are supporting the market and that drove prices up from, I think WTI prices got as low as in the low 60s, back up to recently they were as high as 93 a week or so ago.
I kept hearing on my show, and perhaps on other media as well, that the end of the SPR, the Strategic Petroleum Stock releases, have been a factor in why the price of oil has gone up. Is that true?
Yeah, I mean, it's sort of complicated because there's a debate over whether the SPR counts as commercial inventory from a market perspective, or if it counts as something else. And so if you count it as inventory, then as it declines, as it's supplied into the market, then that should count towards inventory reductions. And should be price supportive. If you count it as production and not as inventory, then the supply is bearish, and when it stops, it's actually bullish. And I think the right answer is sort of somewhere in the middle. And one of the things that I think is happening is as the SPR gets lower, it goes from being properly accounted for as supply to properly being accounted for as sort of essentially emergency commercial inventory. And it's being treated as essentially emergency commercial inventory. And so I think the question is just, when does that actually start to get really priced into the market? And one could argue, hey, that's starting to happen and we're seeing it now. You could also argue that it's not quite yet, and hundreds of millions of barrels total in a reserve that was built at a time where we were a huge net importer maybe is less relevant now that we're essentially a net exporter. And we import products and export products and so on, and import heavy oil and export light, and of course that is happening. But net, we produce a lot of energy, and we export more than we import. So maybe we need a lower amount, but at some point, as we get to a low enough level in the SPR, I think the appropriate calculation on these sort of comparative inventory calculations is to incorporate it into inventories and not supply. And as that happens, again, the reason that's all relevant is you have folks talking about the SPR being refilled or the SPR being depleted. And the SPR getting depleted beyond a certain point is actually bullish for the price. And the SPR not being depleted is actually bearish for the price over the medium term, again, at sufficiently low levels in the SPR. It's just a question of how you account for it. Really, the right way to think about it is that as we get to these low levels of global inventories, which is sort of the big picture for oil, as we get to low levels, small changes can lead to large price movements in both directions. And that's where my call when we last spoke came from for this sort of potential super spike for oil. We're getting to these precariously low levels to the extent that we avoid a deep recession in the US, and to the extent that we see continued global economic growth over the next couple of years. We're getting into a point where we could see a real shortage that could lead to a giant spike in the price of oil, which incidentally could actually be a catalyst for a deep recession.
Okay, so we're going to talk about this recession in just a bit, but to close off on the SPR, the Biden administration earlier in the summer, around June, announced a plan to buy 6 million barrels of oil for the SPR. I think they've cut back on that plan because the oil price has been spiking, and according to the administration, they're going to wait for prices to be, I guess, more affordable for taxpayers was their reasoning. Should they actually go ahead with this purchase and fulfill the entire 6 million barrels, would that have any price impact whatsoever?
Yeah, so I think the joke is that Biden was the world's best oil trader because they started selling the SPR at $100+ oil, and then they announced they were going to repurchase it under 70, and oil got under 70, and they didn't. And so now that they're starting to repurchase small amounts at $90 oil, that looks a lot less impressive from sort of a price arbitrage perspective. But again, that's not really the role of the SPR or the US government to attempt to sort of stabilize prices. And so, yeah, I don't know. I mean, a few million barrels here or there is de minimis relative to the hundreds of millions of barrels that were depleted. There is an argument that it is strategic. There's also an argument that we don't need it as much. I'm not really sure. I just know that as we get to these low levels, it gets increasingly potentially bullish for oil prices. As we see other inventories fall too. And so, adding 6 million barrels, it's just a rounding error. I don't think it really matters. And I don't think it matters if they buy it when oil's at 70 or 90. It's just purely sort of a political talking point. And, I think they mismanaged the whole thing by not refilling, because that would have been great at, a $50 price spread. That would have been great. And, it also would have been great to have refilled it again for whatever strategic benefit there might have been, to have refilled it during COVID, which Trump tried to do, the Democratic Congress tried to block. Now, ironically, there are some cross currents the other direction with a Democratic president and a Republican Congress. And so, the reality is it's mostly just political talking points. And the important part is that hundreds of millions of barrels that were there in case of a supply shortage or some other geopolitical event aren't there anymore. And again, small amounts in either direction don't really matter.
But what is the purpose of the SPR to begin with?
So it was set up at a time after OPEC's essentially export ban around, I think, after the Yom Kippur War. There was sort of this first export ban in the 70s, and then there were some issues with Iran after the Iranian Revolution in 1979. And so the idea was to set up this reserve that would be there in case OPEC stopped exporting oil. And you could say, hey, well, they're exporting a little less oil now, but at that point, they really cut back on their exports in an attempt to sort of shock the market and to sort of force strategic changes, sort of geopolitical external changes in US policy. And so the idea was to build up this supply. It was not really meant to be economic. It was to build up this supply to prevent other countries from having that sort of geopolitical effect on us through potentially withholding oil supplies in the short medium term. So that's where it started. And again, is it so relevant for that anymore? Maybe not. But there's still some benefit to having it. There's some strategic benefit to having it. And it really doesn't seem like the right purpose to have used it for some small changes in oil prices. And to the extent that it was appropriate to, if it was appropriate to use it for that, it should have been refilled after the dramatic fall in the price, and it wasn't. So at this point, political talking points, refilling a few million barrels, getting rid of a few more million barrels doesn't matter when the change was in the hundreds of millions of barrels.
Right. So the SPR is relatively insignificant relative to the overall size of the oil market. The Russia diesel ban is probably also relatively insignificant for the reasons you brought up. What is significant then for your outlook going forward?
Yeah, so the real question is, are we going into a bad recession here in the US? And the answer is maybe. And so it's sort of weird and awkward to put out a white paper saying, hey, we were right that there wasn't a recession, but here we are. A lot of sort of forward-looking data looks terrible. The Fed is sort of nonchalantly walking us right into a minefield, having raised rates as much as they did and sustaining them after this sort of dramatic change, ignoring Milton Friedman and other, brilliant economists' advice to just sort of take it easy and not make drastic changes in monetary policy repeatedly. We're in this point where it's really, no one really knows what's going to happen, but some of these indicators look pretty bad. And so to the extent that there isn't a bad recession in the US and sort of economic contraction globally, oil markets are undersupplied, and they're going to get more undersupplied over the next few years. And JP Morgan just put out this really interesting note where, to the extent that we see significant global growth and we see current low levels of reinvestment into drilling and delineation and exploration for oil, we could be 7 million barrels a day undersupplied by 2030. So that was JP Morgan's view. And I think they're right? If we don't see higher oil prices and reinvestment, we could see much higher prices, and that may happen really soon. The one big caveat is the economy, and really no one knows what's going to happen. And there have been many recession calls and many, hey, the world is ending, and I don't think anyone really knows. So, I would I think that there is this potential for oil prices really spiking. It's possible that an oil price spike could be a trigger for a recession, both in the US and in other Western countries. But I think it's very opaque. And I like to joke that my short-term crystal ball is broken, but I've never had less visibility into sort of the short-term economic picture than I have right now. And so I think that's really sort of the key. If we see growth, then oil could go way higher. If we see contraction, we could see lower prices for a period of time, and then even higher prices as we get back to growth. But we see, the US rig count right now is over 100 rigs undersupplied to sustain the production levels that various agencies are targeting, and to sustain essentially the consensus level for production next year. So it's really, you need a lot more investment, and the longer that doesn't happen, the higher the potential for a super spike.
Well, your short-term crystal ball isn't working. What about your long-term crystal ball? Is that working?
I think so. I think we see much higher oil prices, and again, the less investment we see, the higher the price is likely to go. And so it's just a matter of time, it seems. And to the extent that monetary policy continues as we've seen it over the last, let's say, 30 or 40 years, as things go bad, the Fed tries to stimulate, drops rates a lot, and you see a lot of fiscal stimulus. And again, part of what makes the current economic picture so murky is that there's a lot of fiscal stimulus happening right now, and there's a lot of deficit spending, which is confusing because the economy has been strong. And so it's sort of it's like pro-cyclical fiscal spend, which is very bad policy and really messing up forecasts. But generally what you'd see is inflationary policies in response to an economic downturn. And so to the extent that we see that, which is likely, then we would see inflationary policies going into a very undersupplied oil market, and that would set you up for much, much higher oil prices. So I still think that happens. I just don't know whether that happens, let's say, later this year, early next year, or whether that happens in 2 or 3 years as we sort of suffer through whatever economic malaise from bad economic policies, and then end up in this grossly undersupplied market.
I think this is kind of the theme of our discussion today, is the impact on the economy of higher oil prices. You mentioned that higher oil prices could be the trigger for a recession. Can you expand on that? How would that be the trigger?
Sure. So I don't think anything close to current prices would be a trigger. Again, when you look at sort of refining margins at, let's say, $90 WTI, you're talking about essentially maybe $120 delivered, maybe $130 including gas station margin and transport and so on a per barrel basis. We've experienced that and lived through that as an economy for years in past cycles. And on an inflation adjusted basis, is actually not that expensive. It doesn't feel great to pay what people are paying right now for gasoline or diesel at the pump, but it's really not, on an inflation-adjusted basis, much different. It's actually quite low relative to what we experienced in the sort of 2011 to 2014 timeframe. And so when you look at the potential economic impact from higher prices, I think you need much higher prices, which again would only come from sort of a larger supply-demand imbalance, which we're on track for absent a sort of economic downturn without oil. And so if we're going to get it from oil, what you need is to get the price to a high enough level that it actually forces consumers to consume less, whether it's buying fewer products and reducing diesel demand from the sort of freight and sort of supply chain aspect of oil demand, or whether it's through directly reducing gasoline consumption, either through sort of discretionary trip reduction or through less commuting to work. And where it gets really complicated is we've had all these millions of people working from home, many of whom have been working for these big companies. And what we're seeing now is as big companies do layoffs, they're laying off predominantly folks that are working from home. So, and when you see those people get other jobs, in many cases, they're getting jobs that require them to drive to work, or wherever they're working, they're required to essentially go back to the office or back to their place of work. And so as we're seeing this labor market weaken, we're actually seeing an increase in commuting demand, not a decrease. And so we're seeing a decrease in discretionary demand. We're seeing an increase in commuting demand because, again, we're seeing fewer work from home jobs, more work from office jobs. And then also anyone that wants to avoid getting laid off, it's not that complicated. If you are working from home for a big company, you're a target for layoffs. If you are not working from home, especially at a company where lots of people are, you are much less likely to get laid off. It's not, this is where we've seen this across many different companies already, and it's just globally. And so it's really not, if you're listening to this, the easiest, simplest value add is start going back to the office. And people know this mostly, and so we're starting to see a return to office, return to commute. And again, it hurts your lifestyle, but it beats being unemployed going into potentially a pretty bad recession.
Okay, so what you're saying is people's bottom lines are going to be hurt because they need to travel to work and they need to drive, and oil prices are going to get high and their consumers' discretionary income is going to go down. I think you've just made the case to buy Tesla stock. I kid, of course.
Yeah, I don't know about that. I mean, very expensive cars that are unreliable and don't allow you to do certain sorts of transport activity. I'm not sure in a vehicle, the stock itself is at a very high valuation and has sort of all kinds of hand wavy stories around it. I don't know. I mean, I don't own any shares. I'm not short any shares of Tesla currently. I just don't. I don't think that's a compelling argument. And incidentally, one thing to keep track of that I think is also, I don't think people talk about enough, because of the problems with our current sort of fiscal policies, there's a high risk that subsidies to uneconomic industries like sort of green tech and alternative energy, there's a high risk of those subsidies going away. And the reason is that right now we're running a giant fiscal deficit at a time where supposedly we're growing our GDP by 5%. You're not supposed to do that. So the problem is that interest rates are rising, even as folks are sort of expecting more of an economic downturn, even though at a point in the cycle where you'd actually normally see interest rates falling. And the reason they're rising is because of this deficit. So the problem is, what happens when the government wants to go borrow more money to spend in a downturn? Right? Well, it might not be able to, or it might end up with a 8% cost or a 10% cost instead of a 3% or 4%, or what we used to have a few years ago being a sort of 0 or 1% for cost to borrow for the government. So that sort of fiscal issue and fiscal budgeting issue, it hasn't really been a problem for a while because of low rates. As rates go higher and at a larger sort of structural deficit, you enter a problem where you either go into potentially more hyperinflation or you're forced to cut spending. And when you look at where the government could cut spending, the easiest places are sort of these industrial and consumption subsidies. It's very hard to cut welfare. It's hard to cut Social Security. It's hard to cut defense spending. It's a lot easier to cut trillions of dollars of subsidies to, the manufacturers of products that are mostly consumed by the top, let's say 1% or 3% of the population.
Well, you have made the case last time. I think there's a possibility of a 1979 style oil spike where we have higher oil prices because of a supply crunch, but a weakening economy and perhaps a recession that may or may not be caused by this spike. Right? Is that in the cards?
Yeah, again, I think that is possible. I think it's just a question of does the economy get worse before that or not? And I didn't think that the Federal Reserve would continue to make the policy mistakes that they had been making. They had been signaling that they might shift in some ways. And I also didn't think that the deficit fiscal policy would be so broken and so bad. There are sort of limitations on these things. There are feedback mechanisms and they're being ignored. And so I don't think, I mean, it's very potentially inflationary and very potentially good for oil prices and very potentially bad for the overall economy. And so we're sort of further off the cliff, if you think of the sort of coyote roadrunner analogy. And so I think it's scarier. And again, it doesn't mean that we're going to have a terrible recession. It just increases the chances of a recession that's not triggered by oil, which would reduce the odds, obviously, of oil triggering a recession. If it happens from something else, then that's not happening. But again,
what's going to come first, the chicken or the egg? Yeah.
Yeah, but it doesn't make me less bullish on oil medium to long term, because if that happens, the most likely response is stimulus, both fiscal and monetary, and that will lead to much higher inflation levels, much higher prices, and you'll also have an even lower supply level, because even at $90 oil, we're seeing rigs fall, not rise in the US.
What is the indirect or perhaps even direct impact on inflation from oil? I'm talking about core inflation. I'm not talking about headline that includes energy. I'm talking about core that excludes energy. Is there a secondary knockoff effect on the services sector, or perhaps real estate, or manufacturing sectors from higher oil?
Yeah, so of all of that, I think the biggest sort of single impact is on sort of the freight market, which is why we thought it was so interesting that freight demand was strong. High diesel prices translate directly to high costs of goods, as well as indirectly to higher costs of certain services, let's say restaurants.
Just curious, Josh, just curious, I don't mean to interrupt, but when oil prices go down, do freight prices also go down, or are they sticky upwards?
You can see, I mean, it really depends on the situation. It depends on the supply in the freight market, because it's sort of its own whole thing. You can have an undersupply of trucks, for example, or truck drivers, in which case you might actually see margin just taken by the freight industry. Or if you have sort of an oversupply, which we're sort of closer to that oversupply situation right now, you actually just see that sort of get competed away, and you see that get passed directly through to the companies that are using it. And then depending on the competitive situation and the type of product, you may actually see a price reduction, or you may see that margin taken by the companies that are providing it. But there's I think we're in a competitive enough situation right now across the economy, across sort of the major sort of goods categories and services categories, where there's a lot of, let's say, freight capacity, there's a lot of goods capacity. We're post-pandemic, and we've moved away from most of these sort of COVID limitations and disruptions. And so at this point, I think we're at a point where a lot of these sort of costs are going to get passed through to the consumer, and cost savings can get passed through as well. So I think there's sort of, that's probably the most direct. You order something on Amazon, that price varies, right? And that price, a lot of these prices are dynamic. That price is going to be driven to some extent by what's the price of oil and what's the price of diesel.
All right, well, let's talk about some companies now. Earlier this summer, the Biden administration announced a plan to have oil companies pay more to drill on federal lands. I'm just going to read you a paragraph from the Washington Post here as of July 20th. The Bureau of Land Management outlined widespread changes to what oil and gas companies would pay to operate on federal lands, including raising royalty rates and several minimum fees. The biggest change would raise their bonding requirement for the first time since 1960 to $150,000 per lease from $10,000 to help pay to plug wells for secure leaky ones if firms go out of business or abandon their wells. That's an increase of more than 10 times. Is that going to significantly impact people's margins at all?
Not necessarily this specific thing, but I think like the general policies that we're seeing are pretty industry negative. And so I don't know that this one matters so much as just sort of the trajectory and the message, which is don't drill more, don't produce more oil in the US. And I know that the government will say, oh, we want you to drill more. They said that last year a number of times, and they got mad at oil companies for drilling insufficiently. They essentially blamed high oil prices on US oil companies, even though the year before that, they had been telling companies to stop drilling and stop fracking. And Biden, when he was campaigning, several times said he would end fracking. So again, very confusing, but generally negative messages, mostly from a policy perspective. If you ignore what they say and just look at these policies, any individual one hasn't had too much of an impact, but the general message I think is being heard. And when you look at the investment decisions by U.S. oil and gas producers, you are seeing, I mean, you saw a drop in the rig count this past week, even with a surge in oil prices. And natural gas prices rebounded a little too. People don't talk about that much. And you still saw a drop in the rig count. And so I think when you tell people you shouldn't do something and you increase the regulatory burden and the potential tax burden, you're going to diminish investment in that thing. And then I think that sort of trajectory has hurt valuations of producers and services companies. And I think it makes those companies more interesting at low valuations. But I think those low valuations, the CEO of Pioneer and various other companies have said this themselves, low valuations drive low reinvestment. They're incentivized to pay dividends or buy back stock rather than reinvest in their businesses because they have such low valuations. So Biden's policies and significant increases in regulatory impact. Again, each individual one may not matter that much, but overall, they're stifling investment, they're suppressing valuations. Great for investors, but terrible from a policy perspective because it's driving this sort of price agnostic underinvestment in the industry.
And it's difficult because these companies can't just pack up and move abroad overseas to drill somewhere else, right? So overall, then, would you still stay long on the drilling, at least the exploration sector of the U.S.?
Yeah, I mean, I think it just depends on the company and their setup. I have exposure in the US and Canada as well as internationally. And I think it just depends on what the business model is. If the model is to go to federal land and explore on it to then be able to delineate and develop and produce from federal land on leases that haven't been issued yet, that's probably a problematic business model. If it's to operate in California and hope that there aren't more taxes and regulations, that seems pretty problematic too. But owning producers that are active in Texas or Oklahoma, where the regulatory environment's pretty stable, active on private or state land, I think it can still make a lot of sense. And there's this added benefit of sustained low valuations. And I don't necessarily need other people to come in and buy these stocks to make the prices go up. The companies can pay me dividends, they can buy back shares, they can go acquire additional assets at even lower valuations. And, they can it sort of works out. The lower the value that you pay for something, the better that you can do as an investor over time, even if the sector stays hated and even if regulations stay pretty negative for a while.
Do you have any stocks that you're looking at that are potentially interesting for you?
Yeah, sure. So there's a couple that I own. And to be clear, when I talk about stocks, people should do their own diligence and figure out for themselves if it's a good fit, talk to their financial advisor. I'll just share things that I've bought recently or that I own significant portions of, and people can do with that what they will. So one that I bought and added to recently is a company called Weatherford, which is sort of funny because many people have heard of it, right? Because it's a famous international oil field services company that was famous for various technologies that were innovated decades ago, but people don't really remember that it even exists as a stock. And it did go bankrupt a few years ago, and post emergence, it sold off a number of different business units. So people don't really understand. They don't know to look for, and they don't really understand what they do anymore. And frankly, the diligence process was really tough because I could find many ex-Weatherford employees and very few current Weatherford employees, just because they used to be such a big company and now they're a much sort of smaller and more focused company. What they've gotten down to is being the number one or number two in 4 globally important service lines. And they now have the top tier margins. So their margins are in line or better than Schlumberger, which is better than, let's say, Halliburton and Baker Hughes. And they have the best growth out of that set of 4 companies. So they're growing faster and they have better margins and they have a lower valuation than Halliburton, Schlumberger, and Baker Hughes by several EBITDA multiples. By essentially, if those guys trade at, let's say, 11 times, Weatherford might be closer to, let's say, 7.5 times EBITDA. And so I think it's really unusual to be able to buy something that's global, that has many national oil company and many oil super major clients, and to be able to buy them where again, they can actually do pretty well through a cycle and maintain margin. And they've really been showing great capital efficiency. It's very rare, from what I can tell, to be able to get to buy one of those at a large discount to other competitors, as well as at a valuation that's very undemanding. So I own that. I haven't really talked about it much because I think it's a little different from some of the other stuff that we do at Bison, but it's very cheap relative to the value of its equipment. They have a lot of underutilized equipment, and it's just sort of surprising. The stock's done well. The business performance has been extraordinary, and I still almost never hear people talk about it. So I thought I would share that, and probably get a bunch of negative feedback about how people hate the company and they laid off their friend or their brother-in-law or whatever 3 years ago. And that's obviously terrible, and I'm sorry to hear that happened. But post-reorg companies, their job is to make money for the former bondholders and for the new equity owners, and they're doing what they have to do to stay in business.
All right. Well, excellent insights as usual. Thank you very much. Where can we learn more about Bison Interests?
Sure. Yeah. Just bisoninterest.com, or you can find us on Twitter at Bison Interests. And, David, really appreciate you having me on.
Well, appreciate you giving us your thoughts. Again, great call early in the year. Let's see what happens the rest of the year. Thank you.
Thank you.
And thank you for watching. Don't forget to subscribe and like this video.